Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Charles Cottle from the RiskDoctor, and today is the 4th of October, 2017. So welcome everyone. Welcome Charles. Nice to have you back.
Nice to be here. Thanks for having me.
Sure. Before we get too far, just our quick disclosure: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this is for educational purposes only. And Charles, I know you just were showing your disclosure. I'm sure it's very similar. It's education only and no relevant positions. So welcome back. It's been a while. We're glad to have you here, and hope people sent you some good questions for the webinar.
They did. One question I didn't understand really what was being asked. I contacted the person who asked me and waiting to hear, but maybe we'll cover that another time, or we'll see.
Okay.
So I'm ready to go. I'll start right with question one. I in red here, in the red text, I have the actual question. So this is regarding VXX. And by the way, the PDF of this is with Tom, and so he can forward that on to you. So you could zoom in and do whatever you have to do if you don't see some of the smaller items. So we purchased the VXX. It's a ETF. And recently there was a reverse stock split, 1 for 4. He bought it for $15 a share, and now he's got 1/4 as many at a cost of a little over 60. But here's his trades all in here. I've highlighted and added a couple of columns that I'm going to be talking about. Now that he only has 50 shares, he started with 200. Well, he started with 100 back here in April, right here. And then he bought another 100 on assignment. So he had 200, now he's only got 58. So the basic question is, should I buy another 50 shares so I can do some effective hedging? And I was thinking, that's probably a reasonable idea, but I mean, you can hedge 50 deltas with, verticals and whatnot and different things. So, but then I got into it and I started, because I wasn't familiar with the VXX, and it's really a nasty product that should be avoided. And I'll show you why in a minute. He says that about 40% of his portfolio is dedicated to options trading, but all the trades that you're seeing here are relatively small compared to the portfolio. And this is what I dug into him with. I wanted to know, the magnitude, because, when you talk about strategies, you can pick the most dangerous trades if it's really small, so it matters who's playing with it, how much equity they're working with, how much of their capital is allocated to options trading, and then people can take, high-flying, dangerous risk that I'll sort of outline here shortly. So I think I understand. We'll probably come back to the screen, but I'll move on here. So when I look this thing up, here's this thing just goes down and down and down because it's probably got built-in options premium and it's just wasting away. Look how many reverse splits they've had. They've had 5 over the last 8 years. It's because it keeps going into the turlet. You can read all this why and wherefores, but this is something totally be avoided. I say bail out, stop running up a down escalator. Then I think you should consider the following. And we go over here. Okay. And remove the VXX from your radar. Don't put it on your watch list. It's poorly designed. And why not just consider the VIX? Okay, I'm not a big fan of the VIX, but I took a hard look at it and got some data together. And based on how much money he's risking, he's basically down several $100s, and he's so far he's basically over the 5 months he's lost about $170 per month, trying for an average of $288 a month. Now, this is where I'm going to go back to the screen before. And obviously, this is what he's lost, but he's risking far more. He's long a stock that's 100 shares of 15 is $1,500 he's risking, although it can't go to zero. Well, it could, this stock. It's on its way to zero every, year, and then they reverse stock split it and fake us all out. But I'll just stick with the $170 that he lost, because the stock is currently going for $38.30. His average cost was $55.34. So he's lost $852 over 5 months. Is this $170 per month? Now, why do I say he has a maximum profit? Well, once he sells a call, he's short of puts synthetically. Now, if you say, well, it's a 18 call, the best scenario is that the stock goes to 18. He makes $259 on his stock, and he makes $46 on his call going worthless for a total of $305. And then the next series of trades on the 26th is he buys a put. This one he collared. So this is the only instance where he collars it. But the rest are just covered right, which is synthetically a naked short put. And in one case, he sells puts to open. So anyway, the average potential gain with these limited gain possibilities are these numbers over on the right side. And the average of these is $288. So that's where I'm getting lost 170 to try and make 288. So I'm thinking, okay, gosh, in the VIX, which gets very explosive, it, every few months it kind of doubles from its $9 or $10 range into the 20s, or if it's going for 16, it goes to 32. I mean, it'll do that, right? So why not every month spend less than $170 and buy a call? Let me first give you a little bit of the pricing on the VIX options. Some of you are aware of this. This is something that even the TOS platform only recently added the ability. This was the screen from October 3rd. And notice that they shade the in-the-money calls and the in-the-money puts with this yellow shade and the out-of-the-monies with white. Well, that's erroneous, because that's assuming that we're at 950, which is where the underlying is, 951. But I'm putting a big X through that. That's not where the underlying is. The underlying is where the combo, call minus put, is closest to zero. And if we look at the marks at the 12 strike, that's really the at-the-money strike. And that's confirmed by the futures that trade on the CBOE. And over on the right side, I've circled the futures, current price from yesterday. And it's 1192. And if you take this 113 and subtract 116, that's a -3. So apply that -3 to 12, you get up 1197. So it's off a nickel. They might close at slightly different times, maybe even if they did. So there's some inefficiencies in the market, but mostly the inefficiencies are coming from these wide bid and asks. So if this was a little wider, or it was a $1.05 bid, and this was offered a little bit lower, that would drive up the put lower, that would drive up the synthetic futures price. What wasn't reflected is the volatilities. So look at the volatilities. They're right in line, like the call volatility and put volatility. In the past, that was never the way that Thinkorswim priced everything. They were pricing it off the cash, and what that would mean is, wow, the calls are in the hundreds and the puts are zero-ish vols. I'm sure many of you remember that. But now they got that sorted out, but they still don't shade these areas like they should, because if you look at the futures, so the first one is expiring today, the next one's a week, another week, and then the ones that we're looking at in this options chain are the November 1st with 28 days to go. And so what I've done over here is I've added a couple columns called the basis and cumulative premium. So the basis is 980 minus the cash. So the closest futures were 980 yesterday minus the cash 951. It's simply 29 cents over cash, right? And the next one is the difference between the front month future and the future we're looking at, and it's 72 cents higher. So this 1052 is 72.5 cents higher than what was on the fourth. So I say plus 0.725 to the fourth, and the next is 0.875 to the 11th. And then over here, I'm just cumulatively adding up the premium. So where we're here on the first, the options here, they're about 242 higher than the cash. So I'm looking at, why not just buy the one, pay $113 for one call to achieve his objective? How much could it make? Well, if this is 28 days, if the doubling happens in a month from $951, we're going to $19, right? So that call is going to be $7 in the money. And there might be a little extra futures premium in it as well. So that would be a cherry on top, but it blows away the 288. So let's go and just compare the dates. Remember the dates that he bought these things? I'm saying he got long here, he got out here, etc. In, out. Obviously, he's looking at the chart. So I pulled up the VIX chart. The solid lines, the solid circle here is where he bought, and this is where he got out based on those dates above. And then I've summarized, if he got long at these points, he's getting long on 405, which correlates to the spreadsheet he sent me. And he's out on 417. Here's the difference on the VIX, and that was a positive 287. Right? And if he bought it for a buckish price, he'd have his profit. And here's the yellow one. He got in here. So he's pretty good at picking bottoms and tops with his adjustments. The blue was reasonably good. The yellow was great. The cayenne color was pretty much a scratch or a little tiny loss. And the purple was profitable. So the cayenne might be confusing here. So these solid cayennes, he actually bought 3 different times. He made adjustments, sold puts, etc., added to it. So these are the 3 little circles are the places he bought. So I put the average in the bigger circle. And when he got out at 2 points with the dotted circle here. And so the average was here. So these are the numbers that I took for over on the right. And then the purple, he got him in down here on July 28th, and he got out August 21st. And so these numbers outperform. So the text over here explains what the solid shapes is and the dotted shapes, etc. So when he's bullish or he needs protection, buy at the money calls at your buy points. His buy points are pretty good for a little over $1. And you should be able to more than triple that on average at your exit points. Less cost, defined risk, and ultimately better performance, and a whole lot better than this VXX thing. Question 2. Hi, Charles, can you go over 1 or 2 slingshot trade examples? I know you have spoken on this before, but I'd like to touch on it again. So what I've done here is I've just pulled up Tesla, and it's been in a range. So I picked the November options, and I'm not using Diamondmetrics here. Some of you are aware of my method of using that, but I'm just making it simpler for today. It looks like this is a reasonable range. If it takes out the high and it's a fake out and not a breakout, it might be a little higher. So I just picked some nice even numbers, 300 to 400, even though the resistance is this 389-ish and this support is a little over 300, just to make it real easy, not rocket science, right? And then I put up the options chain, and we could see, we'll use that in some pricing, but over here, I have 3 different dissections using Position Dissector, which is available in that Vimeo package if you've gone up there. So here's the configuration of a slingshot. But then I'm also going to show you a butterfly hedge and a broken wing hedge. If you own the underlying, that's 1 unit of stock. You buy a protective put, that's the 300 I chose because that's going to be the butterfly strike. The butterfly range we talked about, 300 to 400. I'm selling 2 calls at the 350 strike, and I'm buying 2 calls at the 400 strike. And that will leave us with this giant butterfly configuration. So 1 butterfly covering 100 points or 50 points from wing to body. Create 100 baby butterflies. Some of you are familiar with my book and some of my other teachings. And that's explained in a lot of those free videos up at Vimeo, so you don't have to spend any money to try and get your head around this. You're either going to gravitate to this stuff or not, which is fine. And it leaves you with an extra call. And so the idea of this hedge is you're selling 2 at the monies, which generates a big credit, and you're buying 2 cheap out of money, so 3 in this case, way out of the monies. And we could see that if we go back to the pricing, we're paying $5.50 for the 300 put. We're buying a 400 call twice, so that's
say 535 twice, that's 1070
for spending close to $16
for all three options.
But we're selling 2 at the money calls for 21 each. So that's $42 and we're only spending $16. So $26 credit to put on this thing. Well, what do you have synthetically? You have this giant butterfly, which is a probable range that will expire in based on the support resistance that we looked at earlier. And you, in the event of a breakout, which Tesla has been known to do, you're in for a ride. And possibly the stock goes on to victory and you'll clean up over your synthetic butterfly costs, which shouldn't be ignored. What does a butterfly cost? Well, synthetically, it's this call here at the 300. That's, we'll call it
$54
minus 2 times 21, which is 42. So now
that's a 12 debit.
And then up here, another
$5.35.
So it's $17.35
$35
debit for this butterfly that could theoretically go to 50, but who's going to stay in that long? But it could double, right? So it's a nice little hedge, slingshot hedge, right? And in the event it takes off to the moon, hopefully that 400 call goes more than that
2270 in the money. That's $17.35 for the butterfly, $5.35 for the extra call, total $22.70.
Butterfly's going to be toast. It's going to go out worthless, and we have to break even up there
for $22.70,
and then you're going to be in for the ride. Now that's a low probability thing if you look at probabilities. So maybe you don't want that extra kicker. So now we're going to the butterfly hedge. Well, instead of buying the extra call, you buy one. Now you're playing the range only.
You got that same $17.35 on the table, that butterfly.
And that's your hedge. You're protected. That's all you got risk. So if you own the stock that's going for $3.50, you've reduced it to
$17.35.
In the event that it hangs in this range, you got a chance for, your
win range
is like $317 to $383 if your cost is 17. And like I said, there's a good chance that you can double it. You're probably not going to triple that. You're not going to ride this thing to $50. So that's the butterfly hedge, pretty simple. Broken wing hedge, you say, oh, well, you go back to that chart, you say, well, this is a pretty bull trend. I think this support's going to hold. I think it's safe to sell an extra put vertical. You could sell a call vertical.
If you're bearish or there's resistance.
So a broken wing, we know, is a butterfly financed by a short vertical credit spread, right? And to keep it simple, I've just chosen the body and wing strike. I'm going to show you this one where it's synthetically an extra short put spread instead of an extra short call spread. I mean, it would be simpler to, as my hedge, buy one put, compare it to the butterfly hedge, right? Let's go back up into the right-hand corner. The butterfly hedge, you'd buy the put, you got the downside protection,
and instead of
selling 2 and buying 1, you'd sell 3 and buy 2. So it'd be synthetically a 1 by 3 by 2, which used to be called a Buttafuoco. That was a floor term for it on the CBOE back in the 80s. Anyway, I decided to do the more complicated one just to plant the seed, to stretch your mind. And this isn't an easy transaction to put on, as easy as buying 1, selling 3, buying 2, but it would involve buying 2 puts, selling a put here, so straddle, and then a vertical. So there's some different ways to get into it, right? But you end up with the butterfly and an extra short put spread financing it. And obviously, if we look at the prices, selling that put spread, taking in, call it 22 minus 5.5, you're looking at $16.50. So that offsets the cost of your butterfly. Now you own this whole thing for free, right? So that's my answer to that question. A little bit more than you asked for, maybe a little bit less than exactly what you're looking for. I didn't show you what it looks like graphically, but I think most of you realize that the traditional slingshot is just a butterfly. So it's got the pyramid of the butterfly, the wings, but the right wing is just zooming off at a 45-degree angle onto victory, right? So let's move on to question 3. This is a nice little question. So I'm just going to read it verbatim so we don't lose anything in the translation. Dear Mr. Cottle, I have read somewhere that you were an expert on layering butterflies of different strikes for a given expiration. I have been attempting on my own to replicate what that might be like, and I'm attaching an Excel spreadsheet, and that's over to the right here. Okay. This may be too complicated for you to talk about, and I took on that challenge. I don't think so, and hopefully this lands in your court in a good way. But I hope that I could have a chance to ask you about it at some convenient time. If so, I think I should have a conditional hedge that if the market starts to drop by buying trade number 8. So let's get orientated what the spreadsheet is doing. So column 1 is the first trade. I would recommend to SS here.
She did not
Put in the dates. Okay, that's not so important. Didn't say whether it was puts or calls, but I could tell it was puts. And instead of writing the quantity, she's writing the strikes. So she's long the 24.75, she's short the 24.70 and the 24.70. So the way I would do this is in one line, I would say long 1, short 2, skip 2 strikes, and long 1.
This is her
Broken wing configuration, 1 by 2 by 1. But again, it's better to have all the strikes, and I'm going to show you over here what that looks like. So I have this sheet. You could download that, the Vimeo thing, when you get the PDF with all the stuff in it. Here it is, 1 by 2 by 1. That was trade number 1. Trade number 2,
she buys
the 24.65 put, sells 2 again. They're on 2 different lines, and buys a 40, 24.40, right? So on mine, it looks like 1 by 2 by 1, another broke wing, and she's generating a credit each time. So here's the 100 and the 40, and the spreadsheet, you just put this in and put in the prices. You could add the dates. You could say where the underlying is and stuff. It'll calculate your net units. It's a nice little handy tool, and it keeps track of everything. And so cumulatively,
this is her
position now, 1 by 2 by 1 by 1 by 2 by 1, and 140 credit.
Then she continues on
and so on, right? Now we're going to talk about trade 8 in a moment. Let's just go back and just
see her trades.
So
here she
did a regular butterfly trade adjustment 3,
her
trade number 4.
And then she does this
bigger broken wing here and adjustment 4. And this one was a debit.
Obviously, she's not
selling an extra vertical synthetically to generate a credit.
Here she is,
$10.
She's
running at a total of 230 credit.
She buys another
broken wing here
and
generates another $20. So she's up to 250. Does a bigger one, bigger distance. I guess the market's been moving down. And so
this one she's got to pay for, even though she's got a really big credit here. So this is adjustments 7 and 8. Her trades 8 and 9. $1.20 debit and 70-cent debit. And she thinks this is going to solve her problem.
So now continue with the
question. She says,
I think I have a conditional hedge, trade number 8, put spread by the 2400, 2385, which would leave me 2 open short put verticals.
So she thinks
the 2400, 2390,
and the 2385, 2375.
They're right here.
A total risk of $20, and that would be the margin as well, she thinks.
But I'm just going to show you it's different. So I can have another hedge or start a new ladder is my thought. I guess that is where my uncertainty lies. What is the best way to finish off the bottom of the ladder and protect the risk? All right. So I've carried it through, and then I went and took the cumulative position, which is right here, after adjustment H8,
which is her 9.
I'm going to bring up the live position dissector after I discuss this and go back to this point and show you what could be done differently than what she's proposing. But let's just sort of orient ourselves to position dissector here again. So you got calls on the left, puts on the right, they're all puts. So here's, I just copied and pasted, I copied this, pasted it right in here, and then I went about dissecting it. And when I did, I came up with long butterflies, but I came up with a bunch of short butterflies, another long one, and then these verticals short.
Different than her strikes.
But even if you bought these, you still have the dips. And here, this is the same position entered in Risk Illustrator. It shows you where these butterflies, this lavender colored one is the actual butterflies at the going values. I just picked up 17 days to go. And over to the right are the high strikes. So we're long these two butterflies, one with the body of 2470, that's this one. Long the 2455, that's this one. Then we're short this condor. Two butterflies in a row is a condor, and that's why it's got a flat bottom here. Here's another short one. That's why it's dipping below the line here. Here's another short condor.
Two adjacent butterflies.
Right here. Long butterfly here. Now, the verticals are showed in the yellow line. This is the risk, right, at expiration.
That's the margin as well, that $20 or so.
But this is showing you, based on regular margining, what it would be. And then adding this credit to it all raises the whole line to this magenta. So that's the aggregate position, right? All right. So that's where we're at with this. So answer one would be buy these verticals back to 2405, 2395 once, and the 2405, 2390 once, right? But that doesn't do anything for the short butterflies. So I thought that I would go into that. So what I've done here is I've kind of rewound and matched up the position at this point here before trade number 8.
Remember, my adjustment 7 is her trade 8, and my adjustment 8 is her trade 9.
So we're going to go before those to this position, and that's what I have entered in here. So the difference is at the bottom here where these short 4s are, this is where it changes. So here's the two long ones here and a 1 here, that's this. So now I'm going to dissect that. Okay, and it's still got these short butterflies in it, and it's got a different configuration of the verticals.
Which she's asking if she should buy back.
Right? But what do we do about this? Now, if these were all short ones in a row, that would be just one condor between 2450 and 2410, right? So let's just buy that. Let's just, it's probably reasonably priced, but let's just buy that in this adjustment column here. So I'm simply going to buy one big condor, -1, -1, and +1. If I buy that, these go away, but they also add something. They add a couple longs because now I'm going to have long one in here, long one in here. So clear those contents, and there's my two butterflies, one there and one there. Boom.
So if she buys that condor and addresses these verticals, all her problems go away. On the other hand, if she wants to stay short those butterflies and just take care of the verticals, she can take on that risk.
If we look at the pricing of these butterflies, just with 17 days to go, here are all the butterfly prices. 24.10, I believe, is 19 cents. These butterflies, 21, 22, 24, 24, 24, 26, 23.
Now she's got
these butterflies between here and here. This is showing the dissection of the very first position. So, but it's addressing these. So
if she had to buy
this condor, like I talked about, and end up with two long butterflies at those two strikes,
she would be buying all of these synthetically because she'd be buying
this put vertical up here, selling this put vertical down here, and it crunches out to the exact same price. So let's just get the strikes that we're talking about. 24.50, 24.45 in the puts is 32.80 minus 29.60. That is $3.20.
What she's buying and she's selling.
24.15, 24.10 is $1.60. What did I say? 320 minus 160. So $1.60 buys back,
and she
becomes long those two butterflies instead of having been
short them. So that's what I would tell this woman.
Let's go to question number 5. Charles, I have not yet watched your videos, so this may be dealt with in them. But what is the most efficient way in your mind of managing risk of a black swan type event? Think North Korea or another world leader doing something stupid. These things have not affected our markets at all. All these hurricanes, all these shootings, the market just keeps on going. Energizer Bunny. Buying puts seems a bit expensive to me, yes, but I've done some VIX ratioed combos, selling $10 puts and buying 5 $11 calls. So that's like a combo. certainly there's naked risk, but how far is the VIX going to go down, right? It's got like its zero-ish value is like $8 or $9. It's never broken below that. And, it hardly seems that it would. So this seems like a reasonable hedge. I mean, the price of the calls are so much more than the puts, so you have to sell twice as many to pay for them. So this approach seems a little bit more manageable from a cost standpoint, but I'm interested in your thoughts. So I agree, that's reasonable. Okay. I have a little of everything going on, average right now. I only use about 20 to 30% of my total account. This is a traditional margin account, not PM or an IRA. Of that 20 to 30%, it is parsed out as follows. About 20% in width, 10 or 15 deltas, strangles in a variety of liquid futures, including CL, ES, oil, S&P, NASDAQ, natural gas, corn, and soybeans, right? These are all naked shorts. I've attempted to diversify hedge by having a variety of uncorrelated underlyings and staying relatively small, size around 20% of the total account in all positions in this way. 20% in 10 to
20-point iron condors.
30 deltas for the short side on SPX and RUT. 20% in earnings trades at the money strangles, most off within a week, but some go against me and require a few weeks of managing, rolling to reduce losses or scratch them. About 20% doing road trip trades that Tom and Dan do. You guys are really familiar with, and they do that. He does that in the S&Ps, the minis or wherever, and about 20% in a variety, mostly naked puts or ratio spreads, occasional long calls based on some chart patterns and key liquid options markets, Apple, Tesla, etc. As you can see, I have a lot going on in this account, in this one account, possibly too much. And I'm interested in the following. How might I simplify my overall trading, but still remain diversified or hedged? Can or should I be using more than my current 20 or 30% of this account? And how do I hedge it if I do? All right, a lot to unpack here. A lot of what he's asking, he hasn't watched my video, so I'm going to recommend at least one. What you are doing now is not the way to go, in my opinion. What you attempted in the past was the right course, and you need to be patient. So what I mean, the right course, diversifying between road trip trades, those are great. Really controllable, manageable. They got some specific rules, when to get in, when to get out, the pricing you're looking for. It's really sound practice, right? It's got its issues, but for the most part, if you're good at adjusting and you, on top of that, learn what I have to talk about, namely, how these things impact all this layering and how you can dissect it and see where you got to go instead of just relying on the deltas. Certainly relying on the curvature, the T+1 or T+0 graphs help a lot, and it's another way to go about it. But to have this added information about what strikes to buy and sell and the impact of the long and short baby butterflies in your position, it will make everything a little bit more intuitive. All the diversification ratios seem very sound, what he was doing there. You need to optimize and systematize with automation and sophisticated alarms and contingencies for execution and adjustments until mastery. So he hasn't quite cracked the code, but with all the great automation and Trade Monster and Thinkorswim and the scripting that you can do, a lot of this work and setting up all the contingency orders and alarms and whatnot can really aid instead of trying to juggle or manage the spinning plates like on the Ed Sullivan show years ago, and one gets wobbly, you got to run back and forth. That's probably what he's doing. And he's been, getting away with it. The world has started to crumble, but the markets have not caught wind of it. The naked stuff has to be reduced in size because when the markets start to make sense, you will become a walking time bomb, like I predicted in the bonus feature video about super trader Karen. I tried to warn her, I guess nobody sent her the link to the video, and show her how she could be short the same strikes that she likes to be short, that she normally chooses, generate the same credits, all while enjoying defined limited risk. And that's what everybody's got to do. I mean, it's only a matter of time where you're going to be knocked out just like Karen. Poof, she's toast, out of business, So up at Vimeo, start with, and there's the link to that video, and it will show you how to manage it rather than going naked short and, get you on track. So take 2 Alka-Seltzer and call me in the morning. Again, there's so many cool ways with the scripting that's only going to get better and better and better as those systems you're familiar with get better and better and better. I think I'm done. And if there's any questions, we can address those.
Steve asked, what about the percentage of an account someone should use? Did you
Right.
have any ideas for that?
Well, obviously, if you've got $1 million, it should be, up to 20 or 30%, like this gentleman is talking about. But if you only got a $10,000 account, you're not going to be able to, just trade with $2,000 or $3,000. So I think, you might have to use almost all of it, and somewhere in between, based on your net worth, other liquid assets, other income that you have, rental property or anything else, automated income, whatever your job is, in your age, you have more risks there the older you are, so you have to trade with less. You can't risk as much because you need it for retirement. I have allocation tables for like $100,000 account, how I'm risking up to 7% per trade, and it's diversified between broken wings, verticals, butterfly configurations like condors and this and that. But certainly it could involve like some VIX trades where you're short the puts and long the calls, have variations like that.
How did the long butterflies become short butterflies in the dissection you did?
Because of where SS layered,
There's overlap, and it created
short babies. Generally speaking, when you add a new BWB, a broken wing butterfly, where the long options of the long vertical is further beyond the short of the previous synthetic short vertical, boom, it's created.
Let's just go back and see what happens, just dissecting, say, after trade 2, right? Well, trade 2 is easy. After trade 2, you got a butterfly here, you got a butterfly and a short vertical here. So that's not going to help us. And then let's see what happens here, okay? So by adding this one, does it generate any short butterflies in this thing? So let me go and remove this, clear that. And let me just go up to this point here. So that's the 2415. So let me just get out of these, clear. Let me take out these butterflies and I'll just dissect it. So we got to take out these guys here, clear those, right? I don't know what's going to happen. This is live, all performed with no net. All right. So we need to see the whole screen so we can see what we're dissecting. So then there's a long butterfly here. And now you have a short condor after taking out 2 long butterflies right in here. That's short and a short vertical. So it's just because of the layering that it causes that. So here we'd enter -1, -1, and there's your short vertical. It's just the way that the configuration is. And if we go back and look at this, just visually without understanding dissection, here's a butterfly, we're missing one here. So that's short one. Because if we take out a long butterfly, that's going to create a short one lot right here at the 2450. Capiche?
Yeah, Ray said thank you for the answer to his question. Lee says he hadn't heard about you before. He was a bit distracted during the webinar, and he wants to learn more about your approach to trading. So I think that link to your archives is a good place to start. Do you have any other recommendations?
Yeah, okay, so I have that link in here next to the, there. So if you click that in the PDF that...
yeah, put it in the chat too.
Yeah, it goes to this page. All right, and what you get in here, all of this is, you potentially don't have to buy anything. I mean, you got, down here, bonus features, you got basic options, you got chapter 1 of my book, RD1, you got all these Q&As like we did today. There's 17 or 18 of them in here, all sorts of questions, videos on those, including the PDFs. And the Super Trader Karen is down here near the bottom, and Some of you have seen the broken wing butterfly. I think I did this with you, didn't I? With
I think
probability
so.
of success trading or something.
Yep.
Back in the day. Here's something covered rightening. So these are all free. You'll learn a ton. And there's 40 hours. And in the description box, let's see, from Charles Cottle, there's a place here. You download this PDF, and it shows you what's on all these pages. It was last updated it was a couple months ago. It was telling you about my book. Here's telling you what you get free, all these free stuff that's in Vimeo. So these are the links of PDFs that go with it, a total of 2,100 pages, including my book in PDF, all free. Here's PDFs that go with these courses that are up there free. Like, and this one has quizzes in it. So this is from the book, chapter 1. It takes you through part, and then at the end of each one of these has questions and then the answers. So there's the links to all this free stuff, right? Here's all the PDFs that go with the Q&As. Here's Super Trader Karen's one, the covered rightening strike. Here's some other lectures that I did. This was the forums that we had at the time. I've converted them all to PDFs. So these look like forums, but they're actually all in PDFs. All the links should be intact. Pricing of butterflies, etc. So there's a lot of free resources. I would start there. And if you gravitate to it all and you like what you're seeing, then come over here and buy this. And Tom has coupon codes for everybody, $200 off, so only $777. You will get what's on the rest of these pages. Well, here's the first part of the forums that you get on the page, on the 5th page. That's all free. Where these links are blue, that's all the free stuff. But then if you buy the rest, you get all my other courses, RD2, all these intensive, position dissection, which comes with position dissector and diamonetrics, which used to sell for $700 by itself. And then here's all the forums of my coaching clinics, some other courses that I did live, RD3, which was done every day for years, and RDCC. And these links aren't live. So you got to email me after you bought, and I will send you the one where all these links are live. And there's like 7,000 pages of associated materials when you get that.
Beyond that, there's one-on-one coaching.
And it includes a questionnaire where I really dig into who you are, what you're all about, and what your motivations are, what your experiences are. And I try and hone in on what your style is and try and gravitate to what you're already good at. We do some postmortems on some positions that dragged you along handcuffed for a couple standard deviations and show you what you could have done differently proactively before the fact. Be multiplicative for you and get you on track, and then taking you from there.
Okay, and then if somebody did want to do a little bit deeper dive with you, how much would like the 3/4 mentoring sessions be? Okay,
normally my one-on-one coaching is 4 hours for the price of 3,240, because I'm like 1,080 an hour, and times 4, but 75% of that. So
times 3 then, yeah.
Yeah, times 3, yeah.
Okay. And another question, Harold asks, what's the best insurance for a road trip trade against a black swan event? I guess that goes for almost any short Vega butterfly type of trade.
Yeah, I think you guys have covered it pretty well, you and Dan and Ron.
Bertino, yeah. Yeah,
so those are pretty good ways to manage that. But just understanding once you start layering and adding on, that's where it starts to get a little bit complicated. So it gets a little specific about which vertical to buy back, not necessarily just the vertical you're short. Or, if you're short a vertical and you buy equal distance, I'll show you in the dissector. So if you're, say, short this put vertical over here as the one that's the danger one, right? Let's say you're short 2. That makes it an is 2 plus 2. If you go here, equidistance away, for example, it's not the only thing you can do, but that creates a slingshot out of that. 1, 2, I'm taking out 3 now, 3, 2, 1. So it leaves you, it butterflies all this off. Instead of being short these two verticals, butterflies everything off, and it leaves you with a kicker to the downside in the event of a real crash. So that's like one possible thing to look at, but you don't have to buy it here. You can buy it, save a little money, and buy it, say, here, one lot here. And what does that do? Well, it changes. It's not the butterfly anymore. It's only one here, 2, 3. Now you have a 1/2
Ratio back spread.
You got that all butterflied off, but you got this ratio spread. So you could, buy this butterfly, and that would, right in here, an actual trade, buy up this butterfly 1 by -2 by 1. You have a kicker. I mean, there's a lot of different things you can do as you're bobbing and weaving, as your T+0 or T+1 curve, you can flatten it. These are some methods that you can use in your arsenal. Of course, buying closer verticals. So if you, let's just undo this, clear. And you want to say maybe buy this vertical here, -1, any vertical. What does that do? Obviously, it's going to lift up your curve a little bit, right? And it's not going to be as expensive as a naked option. But what does it give you? So 1, because that's what you always got to know. What does it dissect out? Just not the Greek graph, right? And so you're left with this 2 verticals here as opposed to 2 verticals there. One's only 5 points, and it's a starting point. You might have to adjust again and grab another. So now you've changed your 15-point vertical into a 10-pointer by simply buying this one of the 10-pointers here. So, there's different ways to go about it depending on your support resistance. Obviously, if it's just a total meltdown, you want to get to cover that thing or slingshot it off, to ride it out, just to have the extra kicker.
Great. We had another question. Let's see, where was it? Susan asked, are the new versions of Risk Illustrator available?
Not yet. We're creating the new manuals, but the older version doesn't have as many bells and whistles, but that's available, and that's up at my website. It's like $5.49.
Okay, and then Neil asked, do subscribers who pay the $9.97 or the $200 off get copies of the spreadsheets?
Yes, all but Risk Illustrator. And it doesn't also include Diametrics, but it has all the videos for those things because they're good learning tools, even if you don't have the software. It expands your awareness of likely expiration ranges in the case of Diametrics, and in the case of Risk Illustrator, it shows you how to optimize taking advantage of those ranges.
Okay, and if people are interested in getting that $200 coupon, just email support@capitaldiscussions.com, and I'd be happy to send you a code. So I think that's it. We've covered them all. Is there anything else you'd like to say before we call it a day, Charles?
Just have a good one. Stay safe. These markets are kind of deceiving. The oligarchs and the powers that be keep the party going, and they could probably keep it going forever. Our debt of 20 trillion, just add a zero, who cares? So it might never stop, but you got to always be aware that the rug could be pulled out because they make money on the downside too. Once they get loaded up a certain way, get all the pension funds buying all their garbage assets, then they take the rug out from underneath. So you just got to always play it safe. You got to not have the consciousness of naked. There's better ways. And so for a lot of you who are doing the naked, really watch the Super Trader Karen video, and it'll just expand a bit of awareness and add a little bit to your tool chest.
Well, very good. Well, thanks again for coming on. We always love having you here, and hopefully can have you back again in the future. And thanks everyone for staying with us, and hope you check out Charles's video archives. And if you do want to save the $200 off the whole thing, just send me an email. I'll be glad to give you a coupon. So thanks again, everyone. Thanks, Charles.
Take care. Thank you, Tom.